Did you know that there are over 10,000 mutual funds and 3,000 ETFs in the United States? These funds manage over $33 trillion. But here's the thing. Most of us are only interested in about 10 different funds. So why are there so many? It's mostly about marketing. Investment companies like to create new funds based on what's popular to capitalize on the latest trends, playing into the investors' fear of missing out. For instance, clean energy was a buzzword just a few years ago, while artificial intelligence dominates all of our current discussions. In reality, this constant introduction of new specialized funds is largely a marketing strategy. Fund companies create these products to attract investors with the allure of the next big thing, often charging higher expense ratios in the process. But you don't need a special fund for every new idea. The truth is, you can build a great investment plan with just a few well-chosen low-cost funds. You don't need to chase every new trend if you don't want to. Sometimes it's okay to just keep it simple. With all the options available, I'm going to try to simplify the process for most every type of investor out there within this video. And I chose to talk about Vanguard funds because they have over $9 trillion in assets, over 400 funds to choose from, and over 50 million different clients. Chances are that the majority of you out there have access to Vanguard funds within your 401k. So it makes sense for me to review their top funds to have in a portfolio. And as a reminder, you don't need to have an account with Vanguard to invest in most of their funds. You can buy the Vanguard exchange-traded funds, or ETFs, on most every large exchange out there. However, they also have some mutual funds that can only be bought from Vanguard itself. But I'm not going to be speaking to those. Instead, I'm going to focus on the ETFs for this video, but I will show the mutual fund equivalent in case that's important to you. Now for this video, I'm going to break it out into 3 different sections. The first is for the investors that want to keep it simple with a hands-off approach with just one fund to get them started. This will have the least friction where you essentially set it and you forget it. And the second group will plan to be slightly more savvy and they'll want to focus more on a 3-fund portfolio. And the last group, well, they'll plan to be very hands-on with their investments, where they may want to change their strategies as the market conditions change. And for each one of these approaches, I will share which funds I would choose at different ages in life. And it goes without saying that investing is very personal, and there is no silver bullet. Each person's situation is different, and that means that your investment decisions will be very different than mine. For this first group of investors that want a near autopilot strategy, you want something that has consistent growth, but without a ton of risk. Our layout will be to look at the investors that may be starting out at different age groups. So I'll showcase those between the ages of 20 to 40, 41 to 60, and those 61 and older. Regardless of which group you're in, if you're just now starting to invest, I highly recommend that you start with a 401k, a Roth IRA, or whatever tax-deferred retirement account that's available to you. This way, if you don't like your choice, you can easily rebalance your account or you can sell and buy new funds. And that's allowing you to do that without making a tax event. That's because these accounts aren't taxed until you take the funds out during retirement. Or in the case of the Roth IRA, not at all. This just gives you the freedom to make mistakes or change your mind without major consequences. Because this group of investors is just starting, I would suggest the same passively managed fund for each one of them. In my opinion, the safest option would be to go with the index fund like the Vanguard S&P 500 ETF with the symbol VOO, which, as the name implies, it indexes to the S&P 500. These are the 500 leading publicly traded companies in the US based on their market cap. The fund has broad exposure to companies from several different sectors, and it will not disappoint you. Since it's an index fund, it's passively managed, meaning that a person isn't choosing which stock to bet on. It's all based on the index. For that reason, it only has an expense ratio of 0.03%, which is a fee of $3 per $10,000 invested, and that fee comes straight out of the fund's financials and performance. The best part is, as time goes on, the fund will change which companies are in it based on their market cap performance. So it will always have the best of the best. In my opinion, this is the perfect fund to set on an autopilot situation, so you can take your time to better educate yourself on how to invest. And since I am not a financial advisor, I want to emphasize that this is merely my opinion. Now, I know that there may be several people out there that would completely disagree with my choice, and they may suggest a fund like the Vanguard Total World Stock Index Fund with the symbol VT. And this is also a very fine choice, where it has over 4,000 companies within the fund, where the US market makes up over 59% of the fund. For me, having 4,000 companies within a fund provides a ton of diversity. But how much diversity do you really need? Too much diversity tends to dilute the best performers, and it keeps the worst performers in the game, even when they really should be benched. For most investors, I really think that the S&P 500 has plenty of diversity, and it rebalances to ensure that they only have the top performers in it. As I said before, it's a personal preference, so choose the one that you feel is best for you. But as a point of reference, when you compare the S&P 500 fund of VOO to the World Fund of VT over 10 years with a $10,000 investment, the S&P index of VOO handily beat the global option with a final return of $31,000 versus $23,000. And another key item to review is that the maximum drawdown, or the maximum drop in performance, was worse with the global option at negative 25.5% versus the VOO at negative 23.9% over the past 10 years. While the best year performance also lies with VOO at over 31% compared to the international index at 26.8%. But once again, it is a personal preference. And for those that are 60 and older, I do believe that the S&P 500 is the best set it and forget it option. But this group would also benefit the most from seeing an advisor to help set aside investments in fixed income assets like certificate of deposits, treasuries, and even money market accounts to weather out any potential recession. And for those of you that are curious, the average recession lasts for 17 months. And the average time from the bottom of a recession to a full recovery within the stock prices is about 3.5 years. All the more reason for those that are in retirement to have a little extra help to weather a potential 3.5-year downturn at any moment. Let me know in the comments below which fund you'd recommend for a beginner to just set it and forget it. Oh, and here's a comparison of the ETF and their mutual fund counterpart in case your retirement account only has mutual funds. And if you happen to be an intermediate or a seasoned investor, then you know the potential growth in the health and medtech space, where one company in particular is up over 700% in the past year, which happens to be today's sponsor, BioStem Technologies, with a ticker symbol of BSEM, where they want to educate others on their mission of exploring regenerative medicine. What that means is that they utilize tissue allografts in the areas of diabetic wound care as well as surgical wound care, resulting in a faster healing with reduced pain. This is the beginning for the company, where they look to use the body's ability to heal itself in the areas of regenerative health. Basically, the body uses its own system to rebuild tissue and organs. Wound care happens to be the starting point, where there's much more potential in the areas of organ damage caused by age, disease, radiation treatments, and just basic injuries. This is an area at the forefront of biotech that has massive potential, so be on the lookout on your watch list for BioStem Technologies. The next is the intermediate group that may have been investing for a while and they understand the value of a 3-fund portfolio, and I'll list the top Vanguard funds by age group just as before. For that first group in their 20s and 30s, they have a lot more time for their investments to be in the market. Because of this, they can take on a little bit more risk and they can lean in more with high growth funds. If I were in this group today, I would focus on 3 funds of the Vanguard Information Technology Index Fund, or VGT, the Vanguard S&P 500 VOO, and also the Vanguard Russell 1000 Growth Index of VONG. If you happen to have an appetite for a little more risk and more upside, then I would probably have 40% in VGT, 20% in VONG, and 40% in VOO. The growth fund of VGT differs from the S&P 500 index because it indexes against the IT sector with only 321 holdings. And the Russell 1000 fund of VONG, well, it overlaps the most with the S&P 500 at 52% overlap. But the VONG fund has a lot of top performing companies outside of the technology sector that the other 2 funds don't really carry, like Berkshire Hathaway, JP Morgan, Exxon, and plenty more. And as for those that are in their 40s and 50s, I'd have similar funds where I might have 40% in VOO, 40% in VGT, and 20% in VYM, which is the Vanguard High Dividend Yield Index Fund. where the dividend is at 3%. And the reason that I like to have a dividend-paying ETF within my portfolio is because they are from strong-performing companies like JP Morgan, Procter & Gamble, and Johnson & Johnson that all tend to do very well during the good and the bad times. Granted, the total returns are smaller with a high dividend ETF, but the standard deviation is lower, meaning that it has less fluctuations within its performance. Overall, it just brings a little bit of balance to the group. And for those that are 60 and older for the intermediate investors, I'd have the same funds of VYM at 20%, VOO at 60%, and the last 20% within BND, which is the Total Bond Market Index, where it's paying a dividend of around 3.46%. If you look at the historicals on the bond ETF, it doesn't grow much, but during times where inflation is growing, it does tend to perform well. I'd use the BND ETF during retirement as my distribution phase of my portfolio, and that's why I wouldn't own it any sooner than when I'm in my 60s. And it does happen to be very stable, and it helps mitigate the risk of losing a lot during a potential recession. And if I had a small portfolio of less than $500,000, then I'd probably make my percent of BND a little bit larger to weather the potential downturns. But as I mentioned earlier, an advisor may be a huge help with fixed income assets that are better than bonds, depending on the rates in the market. I also want to point out that I do have a free spreadsheet down in the description below where you can look up the 1, the 3, and the 5-year returns on all of these funds that I'm mentioning. And it also lists the expense ratios, dividends, and the max drawdowns. As for the last group of savvy investors that have been doing this for a while, I'm not going to break out the percent for each age within the specific fund. Instead, I'm going to list out the top funds into the groupings that I think are the most important. This will also be helpful for all the other tiers of investors that are looking to learn and manage their portfolio over time. There's also a ticker in the parentheses that are the mutual fund equivalent, if I was able to find them. I'll start with the areas of growth where I'd consider these Vanguard funds, like VGT, which is the Vanguard IT Index, which we've talked about, MGK, which is the Vanguard Mega Cap Growth Index, VONG, which is the Russell 1000, and lastly, VUG, which is the Vanguard S&P 500 Growth Index. And the next grouping is the broad exposure to the markets, both domestic and international. And I'll start with VOO, which is the S&P 500, which I talked about, VTI, Vanguard Total Stock Market, then VT, which is Total World Stock Market, and finally VXUS, which is the Vanguard Total International Stock Index. And next I'll list out the top dividend options where they happen to be some of the top performers within their peers. And they happen to be VYM, which is the Vanguard High Dividend Yield Index, which I talked about, and also VIG, which is the Vanguard Dividend Appreciation Index. And I'll finish the list off with the top bond ETF options. The first being BND, which is the Vanguard Total Bond Market Index, and also BIV, which is the Vanguard Intermediate Term Bond Index. I did not want to insult any of you that are experienced investors by having detailed breakouts, because I'm certain that most of you already have a great plan in place. This happened to be my listing of the top Vanguard funds for most every portfolio. But if you're interested in other top investments outside of Vanguard, then feel free to check out one of my other videos right here on the screen. Thank you so much for watching.